So in this video, we will see about the equity derivatives. Particularly, this is going to be introductory chapter wherein we will be seeing about what is derivative, the origin of derivatives, the derivatives in India, spot market, index. So now let's see about the definition of the derivative. So one of the most significant events in the securities market has been the development and the expansion of the financial derivatives. So derivatives is used to refer to the financial instruments which derive their value from some underlying asset. The underlying asset could be uh, equities, or it could be even debt, or it could be even currencies, or even indices. Some stock indices. So thus, if a derivative's underlying asset is equity, it is called equity derivative, and if it is debt, it is debt derivative. If it is currencies, it is currency derivative. So derivatives can be traded in two ways. One, it can be traded in over the counter, that is called OTC, and another one is exchange traded equity. So in two ways one can trade derivative. But in India, if you take, only exchange traded equities are permitted under the law. This is not permitted. OTC is not legal in India. The basic purpose of derivative, we all know, is to transfer the risk from a risk averse person to the risk taking person. So that is the basic aim of or purpose of derivative. In doing so, the derivatives help mitigate the risk for the risk averse person. That is the reason why he is actually using derivative. For example, let's say like there was a farmer on November. He may wish to sell his harvest after 3 months. Let's say on December, January, and February, November 1 and February 1. So is now sown the seeds, and it will take 3 times, and harvesting will be happening at the February month, and during February month he has to sell in the market. So such a transaction is an example of what he can do is he may wish to sell his harvest at a future date at this date, but he has to agree to this agree to some buyer for a certain price. So that even though the demand falls, the buyer has to procure the harvest at the price that was pre-agreed. So this way is eliminating the risk. So this is an example of a derivative contract. This is one of the example of derivative contract. So here the underlying asset was rice, but however the example I have taken here is an example of commodity derivative. Yeah, commodity derivative is the earliest derivative, but right now financial derivative has gained grounds and it is very popular in the stock market. Now let's talk about the origin of derivatives. So while trading in derivatives, the products as you know, derivatives products mostly has grown tremendously. The earliest evidence you can say about derivatives was the Greek times. But however, yeah, derivatives was in some form of other, they were existing in the ancient times. It can be however contributed to the farmers' need to protect themselves against a decline in crop price due to various social, environmental, and economic factors. So thus derivative contract was initially developed in commodities. So it started in commodities. So the first futures contract, you have to just remember this is a futures contract. The first futures contract can be traced back to Eudoia, um, price market in Osaka. That too, it is located in Japan. And this happened during the year 1650. So this was the first futures contract based on commodity derivatives. The farmers were afraid of prices falling in the future at the time of harvesting. So to lock the price, as I said before, the farmers entered into contracts with the buyers. These were evidently, obviously, the standardized contracts. In 1848, if you could see, Chicago Board of Trade (CBOT), they were actually it was established to facilitate the trading of forward contracts. So first futures contract came, and then only the forward contracts came on various commodities. Okay, from then onwards, the future contracts on commodities have remained more or less in the same form as we know them today. Now let's see about the derivatives in India. So in India, the derivatives market has been functioning since the 19th century with the organized trading, particularly in cotton. Okay, through the establishment of Cotton Trade Association in 1875. Derivatives as exchange traded financial instruments were introduced in India in the year June 2000. So first it was actually on the commodity, but in the year 2001, 2000 onwards, derivatives as exchange on the financial instruments were introduced. That is financial based derivatives, like derivatives based on the financial assets. They were introduced in the year June 2000. So the National Stock Exchange, I would say this financial assets. Yeah. National Stock Exchange is the largest stock exchange in India trading in derivatives. The first contract that was to be launched on NSE was the Nifty 50 Index futures contract. And also in a span of around 1.5 years after the introduction of this index futures, various stock options, stock futures, index options were also introduced in the derivative segment for trading. Um, a series of reforms in the financial market actually paved the way for the development of exchange traded equity derivatives market in India. In 1993, NSE was actually established and it started operations in 1994. It improved the efficiency and transparency of the stock market by offering a fully automated swing-based trading system with real price dissemination. Um, a report on the exchange traded derivatives by the LC Gupta committee was set up. So this is one of the landmark thing to be remembered in the case of derivatives in India. So LC Gupta committee. So this guy actually made a report on the exchange traded derivatives, and he recommended a phased introduction of the derivatives instruments with a bi-level regulation. That means uh, there will be two regulatory bodies, or I would say like two kinds of regulation being imposed. One is the self-regulation by exchanges. Another one is the um, SEBI regulation. So self-regulation by exchanges, and then the SEBI providing the overall regulatory and the supervisory role. So this was actually recommended by the LC Gupta committee, and in his report. And the second committee to work on this was the J.R. Verma committee. And so this was in the year 1998. He worked out the various operational details such as margining and risk management for these instruments. In 1999, if you could say, the Securities Contract Regulation Act was actually of 1956 was amended. So one of the milestone actually was amended so that the derivatives could be declared as securities. So this are the three important milestones, and this allowed the regulatory framework because of this SCRA. This allowed the regulatory framework for trading securities to be extended to derivatives. And by the year 2000, as I said before, the financial assets, okay, as the underlying asset for the derivatives was being implemented in this trading market. So as per the Security Contracts Regulation Act of 1956, it defined the derivatives to include the security derived from a debt instrument, or it can be a share, or it can be even loan, whether secured or non-secured, or any other risk instrument, or contract for differences, or any other form of security. The contract which derives its value from the prices or index of prices or underlying securities. So this was actually the definition of the derivatives in the Securities Contract Regulation Act of 1956. So after the Security Contract Act was amended in the year 2000, 1999, it was implemented in the year 2000, and in the May 25, 2000, the SCBI allowed the exchanges to trade in index futures. Okay, so first it started with the index futures, and in the year June 12, 2000, okay, fine, the trading on the Nifty 50 futures. This is Nifty 50 is the index, it commenced actually. And then in the June 4, 2000, Nifty 50 options commenced. And in the year July 2001, stock options, trading on stock options commenced. So it started with the index futures and then the index options, and then it came with the stock options. And then after that, we had stock futures. This happened in the year same, okay, as of okay, July 2001, but it was in the November 9. So here the stock futures were available for trading, and then it took 7 years after that. Currency derivatives came into the market in the year 2008. In the year 2009, in the year 2009, the interest rate derivatives came into effect. After this interest rate risk in the year 2010, this currency futures came. So futures are always the last to come in each category. But however, it started with the futures for the index. If you could see on the June 2000, Nifty futures came, and then only in the next year 2001 the Nifty options came. Okay, so and then what happened in 2010 of the same year? Then the European style stock options came, and then okay, in the year same 2010, currency options came to the Indian market. So this is as far as okay the development of Indian derivative market is concerned. Now I want to discuss about two important terms in okay current equity derivatives. One is the spot market. So spot market in the context of securities is a securities market in which the securities are sold for cash and delivered immediately. That's a very important thing. It's like on the spot, the cash will be paid and you will get the securities immediately. The delivery happens after the settlement period only. So in the case of India, the NSE cash market segment is known as the capital market segment. Okay, so in this market, the shares of SBI, Reliance, maybe Infosys, on banks. So, and most other companies, publicly listed companies particularly, are traded. Settlement period in this market is T plus 2. That means, okay, whatever time you are actually, trading, it will take extra 2 days. That is, a buyer of the share receives the shares 2 working days after the trading date. Okay, if this is a trading date, then you will get okay after 2 working days only. That is called T plus 2 basis. And also the seller of the share receives the money. Buyer of the share also receives the okay security after 2 working days from the trading date. And similarly, seller of the share also receives the money 2 working days after the trading date. And then another one is called index, which I want to explain. So usually we know the stock market fluctuates continuously. Prices of some stocks might move up while that of the other may move down. In such a situation, how do we say means how do we say the performance of the stock market as a whole? So how can we say whether the market has moved up or whether the market has moved down, or how to in general how to identify the pattern in which it is performing or trend in which it is performing? So therefore, it is very important to have some okay performance measurement indicator or a barometer which can be monitored. So market participants can use this okay to invest in the securities. So one such index is that is called actually index. So that is a way to measure the performance of the stock market. So index is a basket of identified stocks. In the case of India, we have Nifty, which has 50 identified stocks, which represents the Indian stock market as a whole. And similarly, we have BSE that represents the 100 okay Bombay stock, about 100 stocks that is exchanged in the Bombay stock market. So it actually represents a basket of identified stocks. That's a very important thing about index. So, and its value is computed by taking the weighted average price of the constituent stocks of the index. So, weighted average of let's say like stock 1, stock 2, stock 3, and so on up to number of stocks. And this is how its value is derived. So, market index, for example, consists of a group of top traded stocks in the market, and its value changes as the price of the constituent stock also changes. So like we have okay derivatives on stocks, the derivatives on the indices are called as index derivatives, and that's how our Indian okay market okay started. That means our first product in the Indian market was the index derivatives. So this is it as far as this video is concerned, and thank you for watching this video.